Welcome everybody. We are Compass, and this is Need to Know, a new Webisode series where we navigate through the latest industry news, cut through the noise, and get to the good stuff. In each Webisode, our expert team and special guests will guide us through timely topics, complicated concepts, simplifying and streamlining the information, cutting it down to what you need to know. So today, I'm joined by my special guest, Ana Pinto, who's my business partner and also my friend. Ana?
Thanks, Chris. Hi, everyone. My name is Ana Pinto, and I have been an actuary for about 30 years. I've been working with DB plans and cash balance plans for quite a long time. We here at Compass believe that in the marketplace, smaller companies are not given the same DB consulting and guidance that large companies receive. So in our small way, we're trying to bridge that gap. I'm looking forward to discussing cash balance plans with you today.
Great, thank you, Ana. As she said, today's Webisode topic is cash balance plans. So we're going to hit on three main topics and then jump into a few questions from the audience out there. Hopefully taking us to about 20-25 minutes and getting it back to your desks. So topic number one we're going to hit on is cash balance plans. What are they and where do they fit in the marketplace? Number two, the timing of establishing plans and the timing of the funding for those plans. And then number three, the required contributions and the length of time that is required for these plans to be around. So let's jump into it here. Number one, Ana, can you briefly describe what are cash balance plans and where do they fit?
Sure. Well, cash balance plans are actually defined benefit plans that are designed to behave very much like profit sharing plans. There are three key differences. One, owners can make much larger contributions than they could in a profit sharing environment. Annual contributions are mandatory. And the third item is employers make the investment decisions, not the employees.
Great, thank you. In terms of where they fit, just to add to what you were saying, we typically find that small employers typically have an owner, family members that are a little bit older than those employees, creating a little bit more disparity, making these plans much more affordable, where much larger contributions go to the ownership group. A little bit smaller but very meaningful contributions go to those employees. And speaking of those employees, when those contributions are displayed and they get that annual statement, in the old days, in previous pension plans, it was a monthly payment stream. How much money am I going to receive for the rest of my life? Cash balance plans also display that, but more importantly, they give you a lump sum value. What's my money worth today? How much is my employer providing to me this year, last year, so on and so forth. So it can really help with recruiting and retention, really easy, make that communication of that benefit plan much easier.
Another great environment for cash balance plans are solo cash balance plans, where you either have just a single owner or a couple of owners, a husband and wife team. And we see a lot of success with plans that are set up, from the beginning of your business, where you put in a chunk of money every year. Or if you're toward the end of your business and you would like to set up a lump sum nest egg for yourself for when you retire.
Great point. Yeah, so if you're trying to accelerate your retirement savings, could be a great program. But if also you're at the tail end of your career and you say, look, maybe I haven't saved enough over the last 20, 30, 40 years, this could be a great opportunity to put away a lot more money in a short amount of time that a normal 401k and profit sharing plan could afford you.
Right, and those contributions are tax deductible.
Yes, great point. So let's move on to point number two, the timing of establishing plans and the required timing of the funding. Ana, can you comment on that, please?
Sure. With the Secure Act, you can basically start up a cash balance plan as long as you fund it before you file your taxes. We would like you to take a little bit of time and think about the design you want. So you really want to start thinking about putting together a cash balance plan, 2 months ahead of?
Yeah, 30 to 60 days ahead of actually launching the plan. There are a number of decision points that go into designing a plan. Most importantly is, what's that funding level going to be? Because there is a commitment to that. So
correct. Now, contributions are due at the very latest by 8.5 months after the end of the plan year. Or in other words, for most plans, since their calendar year, they're due by September 15th.
Just to add to that, if you're looking at a cash balance plan now, again, thanks to Secure Act, we can actually write the plan now. but have it be effective for 2021 prior to the Secure Act, it always had to be done during the calendar year that you were in. So the Secure Act gives us a lot of flexibility, but at this point, at the time of this filming, we're in April, please file an extension. As Ana just mentioned, 30 to 60 days out puts us well beyond the normal tax filing deadline. So you should already have filed an extension. Most of our clients do that. It gives everyone a lot more time to get the funding in, as well as create those plans.
Correct.
All right, point number 3, required contributions and the length of time. We always hear a lot of questions on these two issues. So Ana, can you comment, please?
Sure. What makes a cash balance plan different from a profit sharing plan is that contributions are not discretionary. And actually, with these types of plans, you have a range. The IRS gives you a minimum amount that you must put in, and there's also a high end of the range, which is the maximum tax-deductible contribution you can put in. We usually recommend that the employer put in the benefit that people have earned during the year. And ostensibly, the interest that is earned in the fund will take care of the interest credit that people get.
Nice, thank you. In terms of length of time, I'll jump in here, and if you can, make a comment. The IRS has this concept of permanence. These plans must be permanent. What number is that? The IRS has never come out and given an actual number. Most of us in the industry believe 5 years is ideal. However, we do have a lot of clients that are at the tail end of their career, getting ready to retire, a little bit older, and 3 years has always worked very well for us. Ana, comments there?
So the bottom line is that you have to be committed to having this plan in place for at least 3 years. And like the IRS says, they consider permanency 5 years, but 3 is long enough.
Yeah, we really want to avoid a situation of companies or individuals that have huge spikes in their cash flow. 1 year may be fantastic, the next year not so good or losing money, because it's that 1 year, maybe 2 year tax loophole that the IRS is looking to avoid and certainly looking to enforce if someone's trying to take advantage of that. So it's our job to help guide you through this and make sure it's the right thing for you, and if you're an advisor there, if it's the right thing for your clients.
Right.
So we covered those 3 topics really quickly. We're going to give you a 4th bonus topic here, just because we're Compass and this is what we do. We always go above and beyond, and that's the investments. How does this actually run? So the investment in a cash balance plan is what's called a pooled account. It's one account. Traditional 401k, profit sharing plan, normally each individual in the company would have their own account. They could go online, they could manage it, choose their own investments. The cash balance plan is one account, run by the trustees and their advisors. Everyone gets the same allocation. All the money is pooled together. Compass record keeps that and provides annual statements so everyone knows exactly how much they have.
Correct.
Anything to add to that, Ana?
I guess my main point is communication is key. Communication with the client, the actuary, the investment advisor, and the CPA, so that we can all be on the same page and we understand business ebbs and flows. So we all need to be part of the team when it comes to working on the cash balance plan.
Great, thank you. So now let's open it up to questions from the audience. So we've got our big board here. You can go in the chat, you can type, you can submit the questions. And right now the board's blank, so we're going to stall a bit and see if it's going to come up.
Right.
If not, we can have our crack team out here read the questions aloud.
Okay.
All right, here's our first one. Do I have to set up a cash balance plan for all of my employees?
Well, the answer to that is not really. However, you do have to make sure that benefits are non-discriminatory. So, for instance, the owners can't have the cash balance plan and everybody else gets nothing. So that's part of my job when we do have a cash balance plan set up, is to look at the population. And usually, if you're going to exclude a group, it's usually your high-paid people.
I was going to say something a little different. I was going to say, yes, generally you got to include all of your employees.
Right.
But similar to a 401k plan, part of what we do is help set up eligibility criteria, whether it's 1 year and 1,000 hours or a certain number of months, certain excluded classes. employees covered under a collective bargaining agreement, interns. So there are a few things that we can do, but generally we want you to think, yes, this is for the benefit of your employees in a non-discriminatory manner. Thank you for that question. We've got a question here that says, can I double up on my contributions this year and not make any contributions next year in a cash balance plan?
And we'd like to say that's an emphatic no. Usually,
good point.
You know, you try to have your contributions as balanced as possible. And this goes back to that concept of, do I even want to have a cash balance plan? If you have a big windfall and you want to stick all your money into your plan this year, and then, you know, next year you have nothing and you want to lay back, that is not how these plans work. You really want to have a steady cash flow for those 3 years.
I like to call it flying under the radar. We want to keep things nice and level and keep you out of the, keep you out of the range of the IRS. Make this plan run the right way, keep it easy, and help you save for retirement and save a lot of money on taxes.
We actually have a good question here. How can I know how much I can contribute in a certain year? You really need to talk with your actuary. Usually, we like to sit down and do a budget and ask you about, you know, what you think your conditions are going to be for the upcoming year. And again, the dialogue is very important. In fact, I have one client who has asked me that question, and I'll have to get back to him as soon as I can. But I did read his email.
Thank you. I'll take the next one up here. How can I know how much, wrong one, they flipped it on me. Can you have a cash balance plan and a 401k plan simultaneously? And that's a great question. The answer is yes, you definitely can. And actually, most of the plans that we design, we're actually balancing both plans together. So we have owners and employees contributing to the 401k plan, getting a great benefit there. Obviously, the 401k is going to have pre-tax and Roth contributions, so it could be some tax advantages there. Then you would have typically a safe harbor and or a profit sharing contribution, and then you have the cash balance plan layered on top. So part of what we do is use those building blocks and help create a nice big benefit for those owners, for those highly compensated employees. Thank you.
Yep.
All right. Our cash balance is a nice thank you from the audience. Thank you. Our cash balance plan similar in cost versus a traditional 401k? And the answer to that is no. It actually is a lot more expensive for these plans. You may be all familiar with all the rules involved and reporting forms with 401ks and testing and discrimination. In a cash balance plan, it's that plus more. Yep. In addition, you've got to have a licensed credentialed actuary, such as Anna, sign off on the plan, certifying that the plan has been run correctly using the proper formulas for the IRS. And there's some additional forms to submit, as well as your typical form 5500.
Correct. The one thing I like to tell people is part of the actuarial standards of practice is to have all the work reviewed properly. It has to be signed off by an actuary, and there's quite a few rules and regulations that I need to follow in order to make sure that your plan is run properly.
Great. Did we do this one already? How much can I contribute? I think we hit that one.
Yep,
we hit that one already.
Yeah.
So here's a question from the audience. Are there currently any ideal investment models that perform well for cash balance plans? Or do most advisors use brokerage or advisory accounts to manage those plans? So I'll start this one, and if you want to jump in. I know that I've been in the industry a little bit less than you, but every couple of years, new models come out, new fund of funds come out. I don't think there's ever been a single instrument that's been able to hit all these targets and do exactly what you want to do with minimal to no risk. So I don't think there's one silver bullet out there. We have used and have seen advisors use a number of different pre-packaged platform products that use nice Morningstar models or something like that, and those do fairly well. But most of our advisors do work with their clients kind of on a one-on-one basis, create a good allocation in an advisory or brokerage account, depending on your firm, and really use a combination of funds, ETFs, and sometimes individual securities to create something and help minimize that risk and minimize that fluctuation. As Anna mentioned before, you're trying to go for kind of a nice slow and steady growth rate.
Correct.
Thank you for that question. How do we withdraw funds, or they use the word undo, we call it terminate the plan when we retire?
Okay, so the very first thing that you have to do is notify your actuary. So what ends up happening is, you let us know, you give an idea of when you'd like to terminate the plan. There's several documents that need to be drawn up, including freeze notices and notices telling people that they're going to terminate. And eventually what we do is we put together benefit packages that are quite a bit thicker than what you see in the profit sharing environment, and employees, including owners, have to sign off. They need spousal consent in some cases. And what eventually happens is all the assets are transferred out of the plan and into your vehicle of choice, an IRA or a rollover to a 401k plan or something.
Yeah, I'll just add to that. Yeah, most employees and even owners would actually roll that money into their IRA, so no tax will be due at that time. And then they work with their advisor to figure out what's right for them in the IRA and how they want to withdraw that money if they're getting ready to retire and need an income stream. Generally speaking, a plan termination, 401k plan terminations can take several months. In this DB world, cash balance world, they take a little bit longer. The average client is 4 to 6 months to completely unwind that plan and have all assets distributed. And then here at Compass, we file a final form 5500 with you to officially close that plan out with the IRS. All right. I'll take this next one.
Okay.
Is the contribution at an employer level and considered a business deduction? Yes to both. So the cash balance contributions are employer funded only. So that's it's company money going into the plan, and the business gets a 100% tax deduction on this. So this is the ability for you to save a lot more money than normal, as well as get a huge tax deductions for you and your business. All right, I think we are at the last question here. So again, thank you everybody. Anna, what is the best cash balance plan design?
That is an easy question. The best cash balance design is the design that makes most sense for you.
Thank you, everyone. Thank you very much for joining us today. This has been Compass Need to Know. On behalf of Anna and Chris, thank you very much. Look forward to seeing you soon.